Welcome to this presentation. We are going to talk about the new One Big Beautiful Bill Act. I'll try to not mess that up as often as possible, and specifically the changes in the law as they impact retirement planning. So there's lots of stuff that's in there. We're going to focus on the stuff that is relevant to retirement planning and retirement planning the way that we kind of do it at Palante. This is the disclosures. This is required by regulatory. I don't know, it's just required, so I put it up there. Nothing here, it should be specific. You come and talk to me if we want to talk about something specific. This is for general education. So reason why we're talking about this, we don't invite or create client experiences for every new law change, but this is a law change that is probably the most significant in the last 10 years or so. It builds on the Tax Cuts and Jobs Act, which was the law that was passed in 2016, which itself was the most significant tax law change in about 35 years. So there are a lot of things in here that are important and relevant to people that are in retirement or planning around retirement. The centerpiece of this is a $6,000 annual tax deduction for people over age 65. It has a limited time window, meaning that it is there from 2025, yes, this year, you'll be able to claim it as you prepare taxes next year, through 2028. I'm going to talk to you about how it's used, who is eligible, and essentially what to expect from it. And it also creates new planning opportunities in the way that it changes the income tax rates. Few other things about this. It eliminates federal income taxes on Social Security benefits for about 88% of recipients through certain rate changes and deductions that have occurred. So they have enhanced standard deductions. They have added a $6,000 per spouse deduction, which means that about 88% of people who are paying Social Security or receiving Social Security, are no longer going to pay tax on that amount of money. That in and of itself creates pressures on Social Security and Medicare and both of those trust funds. So here's the thing about all of my presentations, and those of you who have been with me long enough know this is going to be apolitical in nature. So when I'm either telling you that this is a good thing that has come about of it, or a bad thing that's come about of it, has nothing to do with the political parties that are at play. This is solely from the objective view of a retirement planner. And one of the things that we're talking about having a negative effect is that while it has reduced Social Security taxation for a lot of people, because it's not collecting new revenue, that has an impact on how long the trust fund is set to last through. And it is reducing that or increasing advancing insolvency by 1 year for both Social Security and Medicare, and we'll talk through that. The last thing in terms of just this executive summary before we jump into it, and I really created the executive summary slides for the handout, just be like, all right, let me just remember what's in there, and you don't have to go through all the detail, but you have a 4-year window for planning. And that 4-year window is that period of time where the maximum amount of benefits are available to the most amount of people, and then we expect things are going to change. Most of the people here are already clients of Palante Wealth. Some of you are just friends of ours in the general community. That's okay too. I'm going to talk to you as though you are a client, and then I'm also going to try to give you pointers if for some reason there's planning things in here that we're doing for our clients that you may not be a client yet of the financial services, in which case, not a problem. I'm going to try to guide you in a way that you can come and do that. But of course, I reserve the best advice for people that pay me. Everybody else, nothing. Okay, let's focus on the $6,000 tax deduction first. So the $6,000 tax deduction for seniors looks like this. It's $6,000 per eligible individual. So that means $12,000 for married couples where both spouses qualify. And so meaning that they are both income qualified and they are age qualified. So they have to be 65 years or older by December 31st of the tax year. Because it begins this year, meaning 2025, anyone that's turning 65 this year before December 31st, they could have turned 65 before the new law was passed, which was July 4th. But as long as they turned 65 before this year, they're now eligible. And again, it continues on through 2028. The opportunity for couples to file this require that they're filing married jointly. So if you are married but filing separately, they don't know how to treat the income phase out for that. Part of the reason why you might be filing separately is to get better tax treatment on one person versus another, but you have to file married in order to avail yourself of this. And what's good about this is that this $6,000 senior tax deduction is available both to people that itemize as well as people who don't itemize. So as a reminder, one of the things that's changed about the Tax Cuts and Jobs Act from 2016 is they got rid of that separate personal exemption and standard deduction. I remember you used to have both, okay? They've combined them now. There's just now a standard deduction. That standard deduction was a high enough number that most people stopped itemizing, both because the number was high and because they capped your state and local tax or SALT deductions at $10,000 per person. And most of the itemization, especially for people in the Northeast, came from their property taxes that for most people exceeded $10,000, half of it, right? Half of it was more than $10,000 for a lot of people. And so because you couldn't go more than $10,000, that would have been added to the itemization. You're just kind of stuck with medical expenses, charitable deductions, and those typically, when you added them together, did not get above the standard deduction. So we've changed some of that in these rules. I'm going to talk to you about the increases to SALT deductions and your ability to take advantage of that. Enhanced standard deduction, meaning that we've increased this number. But the good news is whether you stay in standard deduction or you itemize, this $6,000 gets added on top of that. So now for people, you can grow to almost $35,000, $40,000 worth of deductions when you add everything together as a married couple. There are some income limits and phase outs. So the way that this works is if you are filing single or if you are single, the phase out is $75,000. And if you're married, it's $150,000. That's when it begins. It's eliminated, meaning that you don't have this deduction at all available once you reach $175,000 of income if you're single, or $250,000 if you're filing married. So what you'll see there is that each of these is $100,000 more than the one. If you're single, it goes from 75 to 175. If you're married, it goes from 150 to 250. So they're about, they're exactly $100,000 apart. And what you get as a phase out rate is 6% of your income above this threshold starts to get deducted from that $6,000. Now, I know the hardest thing in the world to do as a presenter is present on math with words, okay? Really, really hard. So what I wanted to do is give you some practical examples so you can see the way that this works, okay? So for example, if you were a single filer, age 65, so age 65 tells us eligible, all right? Now we can get it. $85,000 of modified adjusted gross income. That's what MAGI stands for, okay? That $85,000 is what? $10,000 more than the beginning of the phase out. That means we know we're going to have to reduce some of our deduction. So if we go 6% times $10,000, which is the amount over the phase out that they are, we subtract that from $6,000 and that gets us a $5,400 deduction. Now, here's the good news. If you're using a piece of software to prepare your taxes, like TurboTax or something similar, this is all going to get built in. The math on this will automatically do it for you. But I'm teaching this to you so you can keep an eye on it where you're like, did I get my senior tax deduction? First question, are you over 65? And if the answer is no, then that year you're not going to get it no matter what. Then the second question is, if I'm over 65, am I also over the beginning of the phase out? As a single person, do I make more than $75,000 of adjusted gross income? Or am I making more than 150 as a married couple? If the answer is yes on that, now I know I'm not going to get the full 6,000 or 12,000, and then I'm going to get that phased out for there. Well, here's our married couple. Let's say they're both over age 65 and they're making $200,000 of adjusted gross income, modified adjusted gross income. Well, if we remember, that phase out started at 150, ended at 250. That 200,000 is right in the middle of that $100,000. We would expect if they're right in the middle of the phase out, what's going to happen? They're going to get half. Right, half of that deduction is available to them. That's exactly what we see. Each spouse gets a $3,000 deduction for $6,000 total out of what could have been $12,000. Let's take our senior couple, which is to suggest over 65, and now they have $60,000 of modified adjusted gross income. We know that these people are fully within both the age and the income, which means that they're going to get the $12,000. When I add their $12,000 with their standard deduction of $34,700, so $34,700 is what? It is their standard deduction of $31,500 plus $1,600 of an additional deduction per spouse because they're over 65. That's a total of $34,700. I add the 12 on top of that, and now they have $47,000 of total deduction. Right now, they're going to look as though they make $14,000 of taxable income. Everyone see how that works? That deduction is going to offset their adjusted gross income. So now their taxable income is that roughly $14,000, $13,000 number. So as I said to you, I think that most of the software is just going to do this for you. I'm here to let you know how it arrives, how it gets calculated. So if you are reading about this news somewhere out in the world, and you go, what happened to my deduction? You can now go through this filtering and go, well, was I over 65? No, well, I shouldn't have expected it. All right, if I was over, where was my income? Then I should expect something relevant to that. Now, this has some impacts in terms of planning. For the clients for whom we are making larger than average Roth conversions, all of a sudden we have to weigh the relative value of making a Roth conversion, which increases their taxable income, but eliminates the standard deduction or the additional senior deduction versus keeping it. So we now have to take the extra step within the math to make sure that it is still valuable enough to make these Roth conversions. And I think that in most cases, it will still be worth it, especially if we're growing that Roth IRA account we're growing it, but it'll be taxed at zero on all of that growth. I spent all of 1 p.m. talking about growing the account at 0%. And people in the audience are like, why would you grow it at 0%? It was just my brain that was stuck on the idea that I am growing the 0% income tax account. So I'm going to grow it, but I'm going to grow and it's going to pay 0%. That's probably worth more than taking a $6,000 deduction in terms of lowering the income tax. But we got to make sure that we are working through it. For many people, though, it's going to be a great benefit of lowering their income taxes and doing so for this period. As a reminder, this is a limited duration benefit. So this $6,000 is there until 2028, and then it's set to expire. It's going to go away. All right. Any questions on this before I move on to the next kind of impact or change in the tax law for planning? Am I doing that spellbinding of a job of a presentation? I'll take it. All right, let's talk about the next most impactful change, which is the extension or the permanent income tax deduction, okay? So I'm going to walk over here and I'm just going to show these taxes, all right, these tax rates. They have created as permanent the income tax rate lowering, so income tax rate lowering, that existed in 2016. Now let's set up the stage. Why is this relevant? Well, what was supposed to happen is the way that the law was set up in 2016, there was a sunset provision, meaning in 2026, the rates were going to go back up again. They were going to revert to the pre-2016 rates. What does that look like? Well, it looks like that this 10, 12, 22, and 24, I'll just stop there for right now, was going to go to 10, 15, 25, and 28. That's what was set to happen when everybody woke up January 1st, 2026, and nobody had to pass a law for that to happen. It was an automatic sunsetting provision. It meant as planners, we were really bullish on making Roth conversions, especially up to this year. We would have to reevaluate the math as we went into next year because the rates were going to be higher. So this law extended those rates and they make them permanent. Now, I put permanent in quotes, okay? Because permanent is until the next Congress comes in place. And so, again, from the apolitical standpoint, this is good until there's new people sitting in chairs. Will there be new people sitting in chairs in a year or two? I don't know. I have no clue. But I think that this planning gives us an opportunity for at least the next 2 years to keep going. We can do it in 2025. We can do it in 2026. And then if a new Congress is sat in January of 2027, after the midterm elections, we can reevaluate whether or not they're going to change these rules or they're going to continue on. So they've given us a little bit more of a runway to keep doing this kind of planning. We want to do this kind of planning largely because these are the lowest tax rates that have existed since before there was an income tax. So that was the only time that it was any lower. This is literally the lowest rates that have existed since 1911. Everything else has been higher, from World War I to World War II, through Vietnam and Korea. All of that time period had higher income tax rates. Now we're in an environment that's the lowest. So where might we be wrong as advisors? We might be wrong if in the future the tax rates are lower, right? We're placing a bet in our advice that says all signs point to this being a good time to do tax planning because this is the lowest income tax environment. And so for that reason, if for some reason income taxes go even lower in the future, we made a bad bet on it. We're still going to keep taking advantage of tax planning, but we should have waited. There's no way in the crystal ball to know for sure what it is, but all of our clients that are following our advice are largely in alignment with this, saying, yeah, it seems like a good idea. This concept of working with these tax rates and doing these Roth conversions of here is really important as a reminder in retirement because your business partner in retirement's the government. That's the person that's taking some of your earnings every year and they get to rewrite it whenever they want. For me, I feel like, can we buy out our business partner as much as possible? And to the extent that we can shift this from a traditional IRA account to a Roth IRA account and let that account serve as the one that while it grows never pays taxes again, this makes a lot of sense. Not only do I not have to pay any taxes on that Roth IRA account, I never have to distribute anything from it. My traditional IRA has required minimum distributions or RMDs. My Roth IRA account has got none. I never have to take a distribution from there. Let's layer that on top as an inheritance. If I like the people I'm leaving money behind to after I'm gone, if I leave them a traditional IRA, because of the law that was passed in 2020, which is the Secure Act, those people who inherit the account have to completely pay out or take all the money on the account within 10 years. And with a traditional inherited IRA, that money is still taxable to them as an ordinary income. So now if we think about this from a retirement person's planning perspective, by the time you pass away, the people you're leaving money to, if they are children around that age, are in their prime earning years, right? They're like you all were in your late 50s to early 60s, getting paid the most that you would get paid. So what happens when I take more money and add it on top of that? All of a sudden, I'm getting it taxed higher than likely these rates over here might have suggested. You with me on that thinking? Okay. Now let's talk about the planning perspective of which rate do we like or which rates are we planning towards? Well, you'll see over here that the jump between 12 to 22 is 10%. That means every dollar above the $12,000 threshold is getting taxed 10 cents more. 10% in marginal income tax. So if I have a client that can live at or around the 12% tax bracket, which for a single person is roughly $48,000, and which for a married person is roughly $96,000. They are exactly half of one another. It's the way the tax brackets work. If I have somebody that lives there, I like to keep them there because every extra dollar is 10 cents more. But we have clients that their taxable income is going to be at 22%. Nothing that they're going to change about that between their Social Security, a pension, or other distributions that they're taking out and living off of, they're going to stay in the 22% bracket. Well, for those individuals, it makes a lot of sense to increase our Roth conversions to 24%. Why is that? Well, the marginal difference is only 2%. It's only 2%. The growth on this money, we hope, look, no guarantees. This is getting recorded. It's obviously going to be available in a video. No guarantees, but the expected return is at least 4 to 5% on a well-managed account on average. I don't think anybody will disagree that that's a good number, right? I'm not telling you 8%. I'm not telling you 9%. I'm telling you, let's assume for sake of discussion, it's 4 or 5. What's the differential? Well, every dollar that I'm growing this, that's now in an account taxed at 0, even though I paid 2% more in income taxes, I was always going to pay 22. Now I'm just paying 24 on some of it. Every dollar that I move out of here at the higher rate, I save the extra 2% of growth at 0% income taxes. Does that make sense to everybody about the logic behind that? But now I got to stop. Because look at the difference between 24 and 32. That's 8%. Now all of a sudden the bite on that is far more significant. I have to expect a return that's greater than the income tax marginal increase. And so 8% is probably a little too much for us to make a proactive, affirmative Roth conversion. It's hard for that math to equal out. It's hard for that math to equal out. And it's probably unlikely that my children who are going to inherit this account are going to grow into the 32% bracket themselves. It might happen. If I've got $1 million in an IRA and I'm going to add $100,000 onto their $300,000 a year joint income for a married couple, maybe I'll push them in there. That's why all of this work is tailored to each one of our clients. But for the most part, because the top of that 24% bracket is somewhere around $300,000 for a married couple, we're probably safe staying in there. Okay? So that's the kind of planning advantages that we want to take advantage of with this extension of these rates. The last thing that I want to say about this is this. Again, words and numbers and math. This is moving from 10, 12, 22, 24 to 10, 15, 25, 28. With me so far? This 25 that it's moving to is what? Bigger than the 24. So the rate that it's set to go to, or at least was before the tax law change, the place that they thought the numbers worked out well on, is actually greater than that 24% bracket. And even though it's a 1% difference, if I don't have to pay the federal government 1% more, I'm okay with not paying the federal government 1% more. All right. So this starts to kind of illustrate when we're looking at these Roth conversions, why we're advising clients about how much to move and where to get to in terms of the brackets. One last point on this, and I've got a wide array of people who are single and married. I'm just going to talk to the married people for a second and tell the single people to hang out, grab a piece of cheese and come back to me. The married people suffer a tax hit when they change filing status from married to single. Because if you remember, I just said the brackets are half the size. So many times when we're doing this kind of planning, what we're showing is Our married couple might be in the 22% bracket while they're married. But when one of them passes away and all of the IRA goes into the single person's name, and now they still have to take RMDs, but the brackets are half the size, we can show them jumping into another bracket. We can actually illustrate the impact of the change in filing status. And now all of a sudden, when we show that this is the best tax rate that they will ever see, even if tax rates stay exactly as they are, it starts to emphasize the need for this kind of planning, or the value of making more aggressive Roth conversions while we have the time. I always joke with my married couple people, the best planning advantage you have is you all still like each other and want to remain married, because filing married is our best tax planning opportunity because the brackets are so much larger. Let me pause here before I talk about the deductions, because really there's not a lot of changes to them, very small. Any questions on this? Because I know I just talked about that a lot and I went around and went quickly on it, but let me pause and ask, any questions on these tax rates, the value of the planning, how they impact our advice in terms of Roth conversions? So the question was, I keep using the phrase tax-free. Should I be using that phrase with air quotes around it? Is it the same risk of not permanent as these tax rates on here? And I think that's your question, yeah? And that's a really good one, because they can change the rules just like they've changed them on things like the lifetime distributions or the stretch IRA. What I've seen them do is make things prospectively, so people who do things afterwards, the place where they make changes. So they're trying not to make, so they're not changing your Roth IRA, they're changing your kid's Roth IRA. And now your kid's Roth IRA doesn't have a stretch lifetime, it's got a 10-year lifetime, right? Where's the risk? The risk that they make the inheritance of that not a tax-free thing, that you have to take it out of the Roth as soon as you die. That could be a tax law change that they make. I don't think that they'll change your own Roth. So the tax-free nature of it, I'm pretty comfortable, will remain for anybody that has money in this account, with one exception. So when we had the prior administration, we had an 18-page treatment by somebody in the legislature that essentially proposed there being a cap on how much those accounts could own. It came after a report that Peter Thiel had $5 billion in his Roth IRA. And he got there, by the way, by taking distributions of the company that he owned as pre-tax, paying to convert it to Roth, and then all of the growth of the shares of his company, which were now a multiple of it was before, made it be $5 billion. So it wasn't from investing, it wasn't from making smart choices, it's that he owned a stock that he was involved in. It was kind of this self-directed IRA. That offended the sensibilities, so people can be too rich. And so for that reason, they started to change the rules about how much, or there was a proposal about how much you could own. The other change that they had is you could have too much in an IRA. If you had more than 20 million in your traditional IRA, the government didn't want to wait for its revenue. You had to take half of the amount over 10 million and then take that as an income that year, and then half again until you hit the 10 million mark, and then you could take your regular distributions. So what I have seen traditionally happen is the government will get its foot in the door through something that is easy for people to understand, that that's only for rich people. It's only for people who make 400,000, only people over 20 million. And then from there, they ratchet it back. And so that's the thing that I could see is like, if the account could get too big. Right now, there's no present set of rules that are on there or proposal. And the time that you have it in the 0%, where it's growing with no taxes on it, is still beneficial even if they truncate or cut the back end off of it sometime in the future. So from that perspective, I'm not like, oh, well, let's pause from this. My bigger worry or concern, if you ask me to weigh them, is not the change to the rules to the Roth, it's the increase to these. That's my bigger risk that I see, and it's not really necessarily your risk, so it may be like, you might be able to live 10, 15 years, and this is close to where it is. But we've got a bill due. We've got to pay things that we've accumulated a debt for. Someone's going to bear an increase in income taxes along the way. So if it's children that have to pay at rates that are higher, or if we're now 10, 15 years down the road and then they make the change, That's the one I'm more worried about than necessarily mucking around with the rules to the Roth. I think they feel pretty comfortable. When we look at the Secure Act, which is the law that changed the ability to leave an IRA to kids and then have them stretch it out, when we look at those rules were put in place, those law changes were put in place because the federal government was tired of waiting for its revenue. So instead of letting you give it to kids and let them go another 20, 30 years with growth, they said, we'd like our money within 10 years. And that will be both getting out of a traditional IRA at ordinary income tax rates, those rates over there, as well as getting them out of the Roth account where they're not making any money, get them back into the productive world of paying taxes on that money again. So I think that they've tried to increase their revenue that way. All right. Good. Other questions on this? It was a good question. Thank you. Let's keep talking about the extension of these post-2016 tax rates. They've given you some enhanced standard deductions. So we have both the amount that is for people under 65 and the amount that is over 65. This is just a restatement of some numbers that I gave you before, which is if you have a married couple over 65 that are also eligible for the $6,000 in senior deduction, they're going to see a $46,000 combined deduction between standard senior increase for $1,600 plus the $6,000 on top of that. Now, in 2028, the $6,000 is going to go away, but these standard deductions will remain. This highlights for us how difficult it is for people to itemize, or has been, because as a as a married couple, it was hard for me to get more than $31,000 of itemization if I was limited to just $10,000 of state and local tax. But one of the rule changes they put in place for a period of time is that the SALT deductions, state and local tax, are increased to $40,000. So all of a sudden, it brings back in itemization for folks, because especially in the Northeast where property taxes are high, I can now include my entire, going to make up a number, $22,000 or $18,000 tax bill. And as I add that to other things, might be able to exceed what this standard deduction number looks like. Okay. As a reminder, that $6,000 senior deduction is not with respect to whether or not, regardless of whether or not you, irrespective of whether or not you itemize. Okay. You can do both. Yeah.
Go back to
You can.
or I'm single.
Yeah.
See married.
No, so single would do this, 15,750 plus 2,000, that's 17,750, plus potentially 6, which is 23,750. I'm not sure if that's what you said, but 750.
26,350.
No, it's not 350 because I've got this additional kind of increase for single from there. All right, this,
370.
yeah, if I'm otherwise qualified across the board. Right, meaning like I'm below the phase outs and I get the full 6,000. I got to be below $75,000 of taxable income, kind of get that number. Again, the quote unquote permanent nature of these provisions at least removes this tax cliff where we're expecting tax rates to increase just as the clock struck midnight for January 1st, and gives us a little bit more runway to continue to make these Roth conversions and feel comfortable in the advice that we're giving. It also gives people some multi-year planning opportunities. So this for us, as we're advising clients, is a prime window to continue to do tax planning for all of the clients that are otherwise eligible, right? Take advantage of the lower income tax rates. I would even venture to guess, although this is made up of people in here that are both working and non-working, that I can see the value of at least examining Roth conversions even for people that are still working, but are, let's say, in the 24% bracket. I might fill to the top of that 24% bracket of Roth conversions just because it's a good rate to get out of Taxville and put it into the Roth going forward. So I can see us kind of looking at those numbers and say, you know what? I think it's worthwhile increasing this up to the 24% bracket if that's kind of where you're living already. But this is an analysis that we're going to want to make for everybody and then help them with these answers. So I imagine you'll be hearing from Jake throughout our RMD/Roth conversion season, which is from now through the end of the year, largely before December 1st. Okay, and we're going to do that proactively from our perspective. You don't have to ask us. We'll be reaching out to all the clients saying, we've taken a look. We want to have the conversation with you. Or we've taken a look and we don't think it's appropriate to have the conversation. Do you have questions? But we can talk through why we don't think it's appropriate. But we're going to try to make that examination across the board. A couple of other things that we should know about these kind of planning. As a reminder, your RMDs cannot be Roth conversions. So when you get to the time where you're taking your, by the way, just make sure we're all on the same page. RMDs meaning required minimum distributions. That amounts that the federal government is making you take out of your IRA because they've been waiting so long for the money and they don't want to wait any longer. Okay? So if you're born between 1951 and 1959, that's age 73. If you were born before 1951, it was either 72 for a year or two or 70 and a half. But everybody after 1959, 1960 and above, it's age 75. Okay? That's the age for required minimum distributions. That age, when you hit that age, the required beginning date or RBD, what they do is they look at the value of your IRA or 401k accounts. Let's just call them one, group them together. They apply a percentage to the value of that account. It starts at 3.65%. What that math product equals is your required minimum distribution. You pay taxes on that. But when it comes out, it can't go any other place but your other investment account, your checking account. I can't make it go into the Roth. And so one of the things behind this planning is, well, if we already know that this money is going to have to come out, and if we already expect that money to be taxed at a certain number, why wouldn't we take advantage of the years before RMD, make conversions into Roth because now it's in an account that's going to be taxed at 0% as it grows, leave it there rather than waiting for the accounts to grow, take the RMD, and then my only option with that is to put it into an account that's going to get taxed at long-term capital gains or continue to get taxed later. So it gives us this opportunity to get ahead of the storm on RMDs by the time somebody gets age 75. For every time I make a healthy, meaning a good sized Roth conversion, I shrink the size of their traditional IRA so that when they get to that required beginning date, when I apply 3.65 to that new number, it's a smaller product. And so I have less of an RMD. And as I continue to make Roth conversions, I will continue to have smaller and smaller RMDs. And by the way, just so that we're all on the same page, it doesn't stay at 3.65%. Every year it increases because the federal government believes you're closer to death. And for that reason, they want a little bit more money. They're right. They're right. Okay? So they want to increase that up there when you're in your mid to late 80s. It's like 5% of your account. By the time you're in your 90s, it's 8%. By the way, then they never think you're going to really die. They're going to just keep increasing it, and it goes all the way up, all the way up. Sherry.
Understanding you. Once you reach the age of required distribution, you no longer have option to go into.
That's a great question, but it's not what you're saying. So I'm going to restate the question and then correct the answer. So the question was, once you hit required beginning date or your required minimum distribution RMD age, does that mean you can no longer make Roth conversions? That's not true. You can continue to make Roth conversions. In fact, I have a client where we had a big age disparity between spouses. One was in their mid to late 80s, one was in their early 70s. This person looked like they were going to die first. It was probably a safe bet, the older person. And so even though he had well been in his RMD ages for a long time, 15, 16 years, we made accelerated Roth conversions. And in the first year, he took a big RMD and he took a big Roth conversion. But because that big Roth conversion shrank his account, the next year, his RMD was smaller. And then we made another Roth conversion as we took that smaller RMD, and then we shrank it again. And the next year, it was really, really small. And by that third year, we had totally eliminated or reduced, gotten the IRA gone. So there's no timing restrictions on Roth conversions. You can make Roth conversions while you're working. You can make Roth conversions before age 59 and a half. You can make Roth conversions at whatever number you are comfortable paying the tax. The only limit on your Roth conversions is your tolerance for paying the tax, but there's no top cap number. And so there's two rules with the Roth conversions that we should remember. The first is, if we put money into a Roth and we're younger than age 59 and a half, there's the same 10% penalty to take it out like it was a traditional. Okay. The second rule is that if you have a Roth IRA account and that account has been alive younger than 5 years, meaning to say that it's been less than 5 years that you've ever owned a Roth, then there's a 10% penalty on the interest in gains that that account grows into. So let's talk about the solution for that. First, the solution is get over age 59 and a half, or don't look to distribute any money sooner than that. But the second solution, at least from our planning perspective, is that we want to preventatively, proactively open up a Roth IRA account for all of our clients. And so this year, we want to make sure that all of our clients have one, even if it's got $100, because it starts the 5-year clock to be able to touch all the money that's in there, because your 5-year clock is from the date of inception of the account, not from the conversion that goes in there. So if I created one in 2015, more than 5 years ago, and I make a big Roth conversion this year, and it's gone gangbusters, grew 20%, I can take any of that money out as long as I'm over age 59 and a half, no penalties either way, and no tax, of course, because that's the big benefit, is that all that growth is income tax free. With me so far? Off of it? So internally, if you're a client, we're going to do a survey and make sure that all the clients have Roth IRA accounts, open them up, and even make the smallest conversion. I don't care how much goes in there, $100, $1,000, whatever we put in there, just to start the clock, even if we're not making these bigger, structured Roth conversions. And if you're not a client, I'm telling you, go open one. Start the clock, okay? And if you're married, for both spouses, because there has to be an account open for both of you or each of you in order to be able to do that. Couple other things before I leave this subject in terms of Roth conversions and the planning around them. Part of the goal of creating these is to build an account that we can draw from as inflation dictates a higher need for income. Does that make sense? So if you set a budget in retirement, your $4,000 this month won't buy as much 10 years down the road. But if I leave everything in a big IRA, when I go to draw that money out in the future, I just don't take the extra $1,000. I got to take the $1,000 plus the taxes. And I don't know what the tax rates are going to be in the future. And if I switch from married to single, they might be in a new bracket. Like, all of those things are impacts. So it gives me a nice little nest egg. And because that nest egg is really a hedge for the future, it means two things about the account. First, that 5 years for most people goes away, because in their conversions, it's not their tomorrow money that they're putting in there. It's their 10, 15 year down the road money. The second thing is, as an investment strategy, it becomes a lot more tolerable to invest that account more aggressively. So if we think about a normal kind of 80-20, 70-30, we understand that some of those things are going to grow more than other things because they are riskier. That's the return on us taking the risk, is the reward. The fact that we can weather the volatility, we get more of a reward. But in our planning, and some of you have experienced, everyone has experienced as a client, those of you that haven't, you don't replicate the same portfolio in every account. That is to say, the same 12 funds, you don't see the same 12 funds there. So whatever makes up our 70-30, 80-20 is dispersed across each of the accounts based on the tax treatment. And then what we're doing is we're investing the things that we expect to grow the most inside of the account that's taxed the least. Does that resonate for everybody? That ends up being a better strategy That more aggressive, higher expected return investment needs more time for that to be a sound investment. It's got more volatility in there. So that only works if I give it enough time. That's where the math behind that goes. Totally makes sense inside of a Roth because my time horizon to use that money is much more in the future. Hope that's landing for everybody. Okay. Any questions on that before I move on? Okay. Let's keep going. Really no changes in your account limits for contributions. So you'll see up on the board here how much you can contribute to 401ks or IRAs. I do want to point out that your opportunity to make catch-up contributions if you're over age 50 looks like the numbers that are up here, $31,000 if you're married, $31,000 if you're to a 401k, $8,000 instead of $7,000 to IRA contributions. No changes to the RMD rules or the timing of that. The percentages are all the same. So we just put that in the category of all of our current retirement planning approaches and strategies with respect to contributions in retirement accounts, still the same. Nothing changed on that. I still tell people, go grab whatever free money your company is giving you. And then to the extent that you have extra savings available, that's where I'd like you to save into the Roth 401k or the Roth IRA. I don't see a lot of value in continuing to put money in an account that as it grows gets taxed when it comes out. The common analogy here is, or story to exemplify this, is I want you to get taxed on the seed while it's small instead of the harvest after it's grown. Okay? Makes a lot more sense to tax the seed. A couple of other planning opportunities that you have, and now we start to think about this with respect to the new Trump accounts that are the contributions for minors or children. This $7,000 for IRA contributions, this is a great planning opportunity for those of you that have children or grandchildren that have wage income, meaning that they have earned income, but don't have enough cash flow to save into one of these accounts. So this would be understandable that our kids and our grandkids are living hand to mouth, check to check, okay? They might participate in their employer's 401k. That's okay. But they don't have anything extra to put into a Roth IRA. They're not sitting on $7,000 that's not working too hard. All the money's working hard. You can make a gift to them of that $7,000 because if they've got earned income of at least $7,000, they get to contribute it to a Roth IRA, and they can make that contribution with that $7,000, or you can contribute it into the account for them. So we have clients that we have their children's Roth IRA opened, and then we're moving money from their investment account to the kids' Roth IRA, and they're making a gift of that. That gift is non-taxable to the recipient, non-taxable to you if it's just coming from cash, non-reportable, no gift tax, no income tax, and as long as they have their earned income of at least $7,000, totally legit to do. Okay? You can make a gift to them of that money, and then they can contribute that into an account. And now we've made a gift not only of money, which is nice to do, but money that's going to grow and then never be taxed and never, hopefully, be required to be distributed ever again. All right? We'll see what the permanent laws are on that. But it's a good planning opportunity. Let's dovetail this with the new Trump accounts. So the accounts are the ones that are for children. The eligibility here is anybody under age 18 that happens to have a Social Security number. Okay? They can contribute up to $5,000 per year, but unlike a Roth IRA / traditional IRA, they don't have to have any earned income before age 18. So I can contribute prior to age 18, no earned income requirement to put in. You'll see why that's relevant in a second. The federal seeding, you might have heard about the Trump accounts where the government's going to give money. So the way that this works is they're going to give $1,000 for children that are born at least this year through 2028. So if you have somebody that's older than this, they can't get the free money, right? But they are going to get the free money with this restriction. They can only invest in U.S. equity funds with fees of less than 0.1%. So what are we doing here? If we're going to pull apart the political hay that's being made here, the political hay is we're going to give you money, but you have to keep the money invested in U.S. companies. That's why we're going to require them to have a Social Security number. So we've got that issue that's in there. One last thing off of this, there are no distributions allowed, right, until at least age 18, and then they follow traditional IRA rules. What are traditional IRA rules? Well, penalties of 10% if we distribute sooner than age 59 and a half, taxability on all of the gains at ordinary income. Now, most people would not paint me as a cynic, but if I were a cynic, what I would say is the federal government is giving you $1,000 so that you can go grow that money. So then what happens? They can collect the taxes on the way out. Yes, very good. See, you're cynics like me. All right. If I were a cynic, that's what I would say. A couple of other things that are in there, which is that you are able to make contributions for them. First of all, these accounts don't start till next July. So 1 year after the enactment, that's the first time these accounts can be open. You can have an employer contribute this on behalf of the children, and like your 401ks or traditional IRAs, it's tax deductible. So it's excluded from your employee income when it's done. All right. And other than that, I have absolutely no details on how this is going to roll out. No clue. I was joking with the 1 o'clock people that the banks might have a form that says this is eligible for federal seeding. This is the Trump. We don't know. This is a whole part of the Administrative Procedures Act to figure out how it gets rolled out. This is as far as we've gotten in here. But I see a planning opportunity where grandparents and extended family members can contribute to this account, and it gives us an opportunity to do multi-generational wealth transfer without the traditional limitations on that. Meaning, we don't have limitations necessarily. I mean, this is well below the gift amount, but I don't have to worry about waiting for this to be an inheritance afterwards, subject to inheritance taxes if I'm in a state that has inheritance taxes. All of a sudden, I can make a transfer between generations, use this planning that allows us to do that. Now, what I hope happens is that I'm able to take this account and convert it to a Roth. If I have traditional IRA rules, once I'm done seeding this, what I want to do, I want to pay the taxes. When the kids have low earned income and they're in the lowest tax bracket, and then allow this continue to grow. Right? There's a reason why my children are on the payroll of the company. I pay them a salary. That salary happens to be equal to the maximum Roth IRA contribution that they can make. So that money goes into that account, and they never see it. So it grows zero tax going forward. Okay? This gives you a similar opportunity if you're not a business owner. Social Security changes. So a few things about this. No changes in the threshold about when taxation occurs to your Social Security. Let's take a step back and build it for everybody. Hopefully we're all on the same page that says this, but we know this. Your Social Security starts out as not being taxable at all. And then there's what they call Schedule A, which is that they run it through some tests. And if you have what they call provisional income in excess of the numbers that you see on the screen, you start to get taxed on that. So if you make more than $25,000 of provisional income single or 32 married, half of your Social Security is included as your taxable income. And if you make more than 34,000 single or 44,000 married, 85% of it is included as your taxable income. Now, the people who run the numbers on this have looked at it and said, okay, great. Both the increase in the standard deduction, the raising of the SALT limitations up to 40, so now I can contribute more, and the $6,000 for seniors means that most retirees are now below this taxable threshold. By the way, I'll just bask in the irony that when Social Security was first enacted, those of you that are history buffs, it was promised that you are never, ever going to get taxed on your Social Security. It would be stupid to do that. You've already been taxed on this money. This is where it's coming from. You're just returning your own money to you. Why would you get taxed twice? Silly. Until they started taxing you twice. And now what they're doing is they're reducing the amount of revenue that becomes available because we have lowered the threshold, or most people won't trigger the thresholds. We've now lowered the amount of revenue coming in from this additional taxation. And as usual the case with all of these, we're increasing the benefit of the older people at the expense of the people that are coming later. So this reduction of $30 billion annually for the years that this comes in place, and we've talking about at least the 4 years of 2025, 2026, 27, 28, that's as long as the $6,000 senior deduction is. For those years, the impact of that is the acceleration of the insolvency of the Social Security trust fund, meaning instead of it running out of money in 2033, it's set to run money out of money in 2032. And the expected benefit cut is 24% across the board rather than 23%. So we have two things happening. It happens sooner, and we're going to have a 1% higher reduction of benefits when it's exhausted. This also, by the way, because these taxes go to both, have a impact to Medicare. So its insolvency is accelerated to 2032. I could not come across what the benefit cut is on that. Like, I don't know what the impacts to Medicare is. I just know that insolvency on that happens a year faster, again, because we're not generating revenue to put back into the trust fund, which is why those taxes got put in place in the first place. The reason why those taxes came in place, put aside all the spending, was essentially increased life expectancy. So what happens is they were paying out money in Social Security for longer than they thought, so they needed to refund that from the wealthy people that were making money on the outside. It seemed to make sense to tax those people again. We are now not paying money into the trust fund, and so for that reason, we're accelerating it. Couple of strategic considerations for this, all right? As I mentioned to you, I'm sort of cannibalizing the benefits to the younger people. More uncertainty, perhaps lower benefits, perhaps higher age before they can claim Social Security. We might extend the years again. We might reduce the benefit accrual, just to make sure we're all here. If you defer your Social Security between age 67 or your full retirement age to age 70, your benefit increases by 8% every year of the deferral. I could see them cutting that back. That's an expensive proposition. I know why they're doing it. For you not claiming it, they don't have to pay it out, so they want to give you a return on that. But in terms of planning considerations, I'm talking to clients that are pre-Social Security claiming about potentially claiming now, because usually the reason why we're deferring a recommendation to claim is twofold. First, we've done the math, and it turns out that if you can defer to age 70, your whole plan works out better. The theory behind that, or the reason why that works, is when you have a higher guaranteed income, so that's what the deferral does, is it greases my income, I reduce the reliance on the portfolio to support the rest of my budget. My portfolio is volatile. My Social Security benefit is stable. So if I have higher stability, I can lower the demand on this, and therefore the success of the plan is a little greater. That's usually why we're doing it. And the second reason is that the period of time between you getting Social Security and not, so if you turn on 67 or age 70, gives me a longer period of non-taxable income, or I'm not adding to my taxable pile, which gives me the opportunity to do more Roth conversions because I'm not filling my bucket off of it. So it's typically the reason why. Well, if I have enhanced deductions, so if I have somebody that's over age 65, otherwise in a low income tax environment, now I'm adding $6,000 of a tax deduction, all of a sudden getting the additional income from Social Security might not be a bad thing, right? I'm not filling the bucket as much up off of it. And generally speaking, if I can make up the difference of the lower versus higher guaranteed income, if my plan can withstand slightly lower, getting more income in for a period of time might make sense. So it's just an opportunity to revisit the advice that we've been giving now because the landscape is different about the taxability of those benefits. Questions on this before I shift over to the ACA premiums for people that have to pay for health care between age retirement and age 65? Good on this? Okay. I'm either boring you to death or you're just so impressed by it that you want to hear the rest of it. The new bill didn't extend enhanced premium tax credits that were set to expire. So the way that these worked is that if you were paying premiums for the ACA, the Affordable Care Act, this is typically the case, by the way, not for people that are kind of uninsured while they're working. We have clients that decide to retire at age 60 or 62, don't have health care benefits from their job, so they weren't state workers, they weren't teachers, something along those lines, and they have a time period before they can claim Medicare at age 65. So what do they have to do in their plan? They got to pay for their own health care. And so these folks were going to the marketplace, the Affordable Care Act marketplace, and buying themselves health care. This is the silver, bronze, gold plans. Those plans, to encourage people buying into them, we were given some tax credits for the people that bought into those plans. Those enhanced tax credits aren't extended. They were set to expire in 2025. They are in fact expiring. So what this means is that there is going to be an increased cost for this coverage for folks that are needing it. They estimate that the increase will be about 75% for Medicare. So now our budget has to increase. We were quoting maybe $800 per individual. If their spouse is $800 per person per month for the bronze level plan. Silver plan was more like $1,000. So now all of a sudden I have to increase that by 75%, test the budget to make sure that they're okay with this increase because nobody's going to go without health care. And then I say, okay, our budget now has to increase in the early years before we stop paying for it or we pay for the Medicare benefit, which should be a lot less, $170 to $180 per person at the lowest one. In addition to a coverage loss for about 5 million people, there are also some changes to the enrollment periods. No automatic re-enrollment, so you're going to have to reapply for each of the years. They've administratively made participation in this more difficult. As a planning matter, the impact of this is people that are not eligible for Medicare should budget higher ACA premiums beginning next year. It's impacted my clients that want to retire early, which for most people they'll define as being younger than age 65. It's redefined a planning item for them because I got to have a line item on their health that's going to be increased, and I've got to rerun that. And starting to budget. Those are the two things. Good. Questions on healthcare premiums before I switch to estate taxes? Good. We're speeding along here today. All right. Estate planning changes. So one of the things that they did was essentially extend or increase the federal estate tax exemption. So they are now $15 million per person beginning January of next year. That's an increase of about $1 million from the current amount. This changed a rule in place. It was set to cut essentially in half. So we would have reverted to about $7 million of an exemption. So this means that for most people, this change means that if you had forgotten about and not cared about estate taxes because of the way the law was set up, you can continue to forget about it, right? Because if you didn't hit these thresholds before, you're not going to hit them now. For clients that are in that mid-range, that $7 to $10 million, all of a sudden, we've got to keep running projections because that amount's set to increase by a cost of living number, and your wealth might increase greater than that. So now we're skating to where the puck's going to be, and we do have clients where $15 million, where they're single, and $15 million is a real number for them. And so we've got to do the projections and help them with their planning. This is not set to sunset, meaning that we're going to be with this law until they vote to change it. And that actually is a change from a long period of time. Since about 2008, they have always had a sunsetting provision on the estate taxes. We were always with like the sword of Damocles over us, just waiting for the estate tax to lower. Now it's at least permanent in the sense that everything else is permanent. Okay. As I mentioned to you, the strategic implications of this is that the higher permanent exemptions really reduce urgency for people that are in that wealth transfer that are above that limitation off of it. I mentioned to you those mid-range estates, they get some flexibility. especially if they're married, and I can double those numbers. But we should still be looking at doing normal wealth transfer strategies for people that are above that amount. All right, let me summarize the benefits or changes in here. The first thing is that there are 2025 retroactive benefits. That's going to include the senior $6,000 deduction, the small increase to the standard deductions, the fact that the tax rate is extended past this period of time. So within this year, it helps us focus on and continue to do Roth conversions. And as I mentioned to you, the SALT deduction increases to $40,000. I put this one in here because I do have some people that are working. So if you're working and you work for tips and overtime, you've got some deductions that are available beginning this year. Okay. In 2026, we're going to get the increase to the estate tax exemption. We have the opportunity to start to use these Trump accounts. Those are the accounts for minors. We're going to have the impact of the ACA premium tax credits going away, which we expect are going to be increases to those budget items. And here's a new one. We now have a floor on charitable deductions before we can start to itemize. This starts to make sense if you have you see all the moving parts. If I increase SALT, then I have these other deductions in here. Now all of a sudden, to reduce the chance of people itemizing, I now need to put a floor in place for my charitable contributions. And now I need my charitable contributions to exceed 0.5% of my adjusted gross income before I get to itemize that. All right. Now, again, I expect that all tax planning software will calculate this immediately. But the planning thing for you all is if you're regularly making charitable contributions, you want to track the amount of that, and you want to track and understand where your AGI is to know whether or not it's even worth itemizing. So am I going to toss the receipts this year, or am I going to be able to use them? Well, where is my adjusted gross income for that? All of a sudden, clients that might be making higher Roth conversions, that is to say, increased adjusted gross income because they're converting more money out of their IRA, may not be able to make the same amount of charitable contribution deductions because as I raise the AGI floor, I also raise the minimum amount that makes them be deductible. Now, I haven't seen this be an impact for a lot of clients that we're working with that are using an advanced strategy called a charitable remainder trust. A charitable remainder trust is used for people that have large appreciated assets, so non-IRA assets. They bought Apple stock 40 years ago and in a savings account, it's now worth $1 billion. They're usually hesitant to sell those because of the taxes that are going to be implicated. So instead, what we do is we contribute those into a charitable remainder trust. And this is great for people that are charitably inclined. So it gives them the opportunity to leave 10% of that value to charity. The rest of it, they get to keep. They get to sell all of that income tax free. But another benefit is that because I gave a lot of money into this trust, you're usually working with about $250,000 or so to think about this strategy. Because I put a lot of money in there, I get to take a charitable deduction based on the amount that I put in there, and I get to spread it out over 5 years if I want. So we have people that, I had a client, that client had about $1 million inside of a Fidelity fund, and that account had grown. Most of the $1 million was gains to them. We wanted to be able to use that money as part of the retirement planning, but we were hesitant because of the taxes that were going to be involved. Because there was so much in gains, they would pay 23.8% in long-term capital gains because they were above a threshold. So instead, what we did is we gave that $1 million into the trust and we sold it there. And when we sold it, the income tax on it was zero. Because that trust has a charitable ultimate beneficiary, I could get a $350,000 tax deduction, straight line tax deduction. I could spread it out over 5 years. What we did for that client is we took that $350, and what did we do? We balanced it against a Roth conversion. Now I made $350,000 of a Roth conversion essentially tax-free. So I got 2 benefits from it. What I think is going to happen with this charitable deduction floor is that I won't be using that over 5 years. I'll need to aggregate and make a bigger deduction in year one. I'm going to have to meet the minimum of that. Whereas before, as long as I made more than $31,000, remember that is my standard deduction. As long as I counted more than $31,000, that was worth itemizing. Now I have to count and balance that against my Roth conversion to make that be worthwhile. Okay. More things off of timelines. The 2028 expiration cliff. So this is the time period in which stuff that I've been talking about goes away. So the first thing that goes away is that $6,000 additional deduction for people over age 65. Also your tips and overtime deduction. There's some benefits for car loan interest deduction. Our federal seeding for those Trump accounts goes away also for that. All right. We've got a few strategies to talk about. So the first key planning strategy for income management is to take advantage of these enhanced deductions with our Roth conversions to try to minimize the impact of taxes by doing it. So between the enhanced standard deduction, the $6,000 that's in there, all the rest of the planning, and the fact that we are going ahead and continuing the lower tax rate, take advantage of all of this and continue to make our Roth conversions and put those accounts growing and then eventually tax at 0%, right? Reminder, there are no RMDs from that. We definitely want to take advantage of charitable giving as well as tax loss harvesting. So the tax loss harvesting automatically happens just in terms of our management, but I'm encouraging this here as an income management because our tax loss harvesting now gives us an opportunity to reduce people's AGI below the phase-out thresholds. So if I can harvest tax losses in years that keep me below $75,000 if I'm single, or $150,000 if I'm married, all of a sudden it's going to give me a $6,000 tax deduction. So now we can be proactive about the use of these so that we can maintain eligibility for this. That will particularly be the case between 2025 and 2028. And because these are periods where we expect low income taxes to exist, these lower rates, plus also these additional standard deductions, the senior deductions, it gives me an opportunity to spread recognition of taxable income across multiple years. I don't have to put my thumb on the scale and get this done all in 2025. I can now spread this out because I have benefits that at least I think are going to continue for the next 2 years through the next legislation. And then if we get word that continue beyond that, even better. We have a couple other risk management considerations. The first is budgeting for ACA premium increases if you have to pay for health care between ages, let's say, 62 through 65, anytime before age 65 in Medicare. And then also consider accelerating your claiming on Social Security. Again, this is an opportunity if you're working with us to rerun these numbers for us to figure out, does it make sense for us to reduce the amount of money that we are going to be getting from Social Security as a guarantee to get into the system earlier and also have it not be as much of a negative tax problem because of all of these other deductions that are in there. So we're looking to get into this, especially if there's going to be a reduction of those benefits from the trust fund situation. If there's 24% across the board reduction, well, geez, getting more money in at 100% in earlier years all of a sudden seems to make sense as a risk management perspective. These are all trade-offs, of course. Okay, any questions on the OBBBA Act A? Before I shift to something else that I want to talk to you about, it's especially going to be for people that are already clients. I'll pause here, make this a substantive discussion. All questions are good. I have a couple of things I'm reminded of that I talked about at 1 o'clock. One of the additional benefits of money that's inside of a Roth is that when I take money out of there, it doesn't affect how much of my Social Security is taxable. Remember those thresholds that make 50 or 85% of it? None of the Roth IRA counts towards that. And that's very different, for example, from things like municipal bonds. A lot of people use municipal bonds as tax-free income, but all of the interest from municipal bonds counts towards that Social Security calculation. So my Roths don't do that. My Roths also don't affect how much Medicare premiums I'm going to pay in the future. So my Medicare premiums are a function of my modified adjusted gross income from 2 years ago. So the higher my MAGI, the more Medicare I pay. And just for fun, the Medicare tiers don't line up with the income tax tiers at all. These are one set of tiers. These are another set of tiers that kind of overlap. This is TIERS. I mean, you might have tiers of TARS, but my tiers inside of there are the fact that you could be in the 22% income tax bracket, but be tier 1 for Medicare, or if you take too much out, be in tier 2 from it. So none of my Roth withdrawals impact how much Medicare premiums I pay in the future. So they help me in the future when my budget, my cash flow is more constrained because things are more expensive. Inflation has impacted that. It allows me to live in a world where I don't lose as much of my Social Security to Medicare premiums because I stay in the lowest tax bracket. Whereas if I kept it all in a traditional, now all of a sudden as I took more and more out as my RMDs require me to, even if I'm not spending it, as my RMDs grow, now all of a sudden that might push me into higher Medicare tiers. So it allows us to balance that. Other questions? Not that there have been any, but I'm just saying I've shared something with you. Questions from that, questions from anywhere else? Okay. I want to talk to you about one more thing. By the way, I'll be up here at the end if you'd like to ask me questions. I'll turn off the mic so that's not broadcast to everybody. I do want to talk about one thing. And so for those of you that are clients, I want to remind you about the existence of the portal that we have created for you. So what's nice about this is we've built this portal because we want you to feel that your world is kind of organized and it's under control. Our goal here is to simplify things. We want you focusing on leading a great life, not juggling the details of it. So we've tried to make this as simple and as cohesive as possible. Now, this might look strange to you for people that are already clients. I know it looks strange for people that aren't, but this is what your portal looks like when you log in. This is the landing dashboard of it. You'll see inside of here that there is a dashboard that gives you on the top side your total net worth, the amount of money that we're managing, your cash flow, because there's an income and expenses section. There is even sort of a rudimentary portfolio projection inclusive of spending and how much money is going to be coming out, so you can extend out your retirement age. And there's a really great button in that little purple area called Link External Accounts. So for those of you that finally had wants to simplify or centralize everything, you're going to have an opportunity to connect those. But again, the intent here is we don't want you digging around for things. We want to have one space where your things lie, including, for example, your outside held accounts. If I click that Link External Account, it gives me the opportunity to link things that we're not managing that might be relevant for you. So you might have a checking and savings account that we want to be able to see everything in one spot, and it allows you to tie that stuff in. Any of the annuities that we've put together for you, you would be able to log this in. Now, we need your help here because these credentials we never see. This uses one of two different secure platforms, either called Plaid or Yodlee. And those people do a handshake where they're not saying your passwords either. We're not saying you just enter it. It sends it over and it draws this information in. So we could manually add these, but because this has got these clickable links, it's going to have an automatic feed to whatever the balance is on there. We won't see the investments themselves, but we'll be able to see the balances, and that's going to drive your total net worth number so you can see everything at once. Key updates, everything on a snapshot. Traditionally, people's financial life is scattered. I usually say that they have a kitchen drawer of financial stuff. You know, the drawer that's got like the menus and the little rubber band and then a pencil. And in mine, there's like an eyeglass screwdriver plus my super glue because I need it all in one place. What we want to be able to do is simplify all of that. Instead of having a junk drawer in the kitchen off of it, have one place, everything, kind of here, clarity to what we have. And we want to help you, by the way. We're not leaving this to you. We have got the team. Part of the reason why the team is in the back over here is to say, hey, if you want to use this, we want to walk you through connecting all of these things to it. For example, one of the things that Kiana did is go through everybody's legal file that have created an estate plan and complete the estate planning section of it So we know what trusts you have, so you can see them. You can see your wills, who are the executors, power of attorney agents, all of that stuff in there. I don't think there's anybody here that has anybody but Medina Law Group as their lawyer, their law firm for it. But we'd be able to list somebody on the outside if you want to fire the law firm, but keep the financial services firm. But it helps us basically see, is anything missing? It gives you an opportunity to kind of get reminded without having to go to the documents. Hey, what's the summary of what this looks like? Again, all under one umbrella. It also gives us an opportunity for a document vault. So there's a couple of things that are in here. Important documents get lost. Sensitive information probably shouldn't go through email. I'm coaching lawyers for a long time at the tech show, and I told them, if you want to send something in the least protected way, send an email. Those are the easiest things for people to snatch. This gives you a button to send us a message, and we would get an alert from that. It has a button to upload a document. So if you want to send something to us, especially something that is sensitive, okay? Something that might have numbers to it that need to be protected. Gives you an opportunity, or Gus to give you an opportunity to give you tax forms. So all your 1099s are here. That helps you when you need to send them to someone else. You don't have to collect them along the way, sort of a vault. But your essentials are here, protected 24/7 and accessible. The last thing to highlight is this performance snapshot. So a lot of times you want to see how things are going, especially with respect to money that we're managing. So right below from the top, underneath there, you'll see two numbers that are always populated. These are the returns from inception to date. That means the date that you started with us till today, and the performance of year to date. The important thing about the top number is that the inception to date is annualized. So you're looking at numbers that are every year you have averaged 4.12% on this example here. Other firms, I think, shy away from transparency, but we really embrace transparency and education. Would love to talk more about this. There's even a button here that says view performance, and you go into a completely separate area that allows you to divide it up by sector, every year, rolling 5 years. And the last thing about those numbers in there, just so we don't pad anything, is that those numbers are actually net of fees. So we're actually showing you the performance of your own money, not like we're hiding something about our fee that's included in there. But you always know where you stand, clear, honest performance data that builds confidence and trust. But that link is in there if you want to dive deeper, kind of if that's your thing. The last thing in here is with respect to the portal, it really isn't about a filing cabinet. We believe strongly in looking at these 4 pillars of income, investments, taxes, and estate planning as a rubric, as a filter to see what's going on with your life. Are we generating the income that you need? Are you feeling comfortable with that? Are your investments aligned for the goals that are in place? Are we maximizing taxes? Are we looking at estate planning? But the reason why this is here is that from the perspective of this being holistic, it allows you to have peace of mind that we're watching over everything that's in here, that there's complete transparency of what exists in your stuff. And there's nothing being hidden, or you got to ask for it, that we have an open conversation about that. And the more you use our services, the more seamless and stress-free your world comes. That's really what we're looking for. This isn't about the technology. We really want to give you this freedom to lead your great life. We'll worry about the details. You go make the memories. We're really trying to get this kind of peace of mind, not just for you, but for everybody that you care about as well. I wanted you to think about this portal almost like a safety net, your launching pad, so that when you're logged in, you know that you're cared for. And if you want help on using this, sometimes we did this at 1 o'clock and people are like, I didn't even know I had one. Like, I know you had one because we made sure you logged into it. You just forgot about it going forward. But if you'd like to use this more, we would love to see you use this more, and our team will help you with that. The last thing that I'll put in, and then we're done for tonight, is our next client experience. So we try to balance client experiences that are fun for client experiences that are educational. So you have this little card that Katie puts together. It allows you on the QR code to register. If you were a pickleball person, and some of you are a pickleball person, like wearing the t-shirt, we would like you to register. By the way, you should come no matter your skill level. So if you're brand new, they're going to have instructors to walk you through that if you've always wanted to try it. you can go and do that. We're going to have tournament for people that are well practiced. And if you really want entertainment, you will get to see my wife and I try to work together as a team playing pickleball. She gave me a gift for anniversary. Oh, we've rented out the entire spot. What's the name of it, Katie? Mercer Bucks. The entire one is ours, inclusive of food. We're going to make it an entire evening on October 22nd. But yeah, my wife gave me the paddles and the ball in a box as an anniversary gift. August was our anniversary last year. So it stays unopened. We've been waiting for the right opportunity. We think showing off our marriage skills in front of you all is the right opportunity for the pickleball. Okay? That's it. You guys all have the information for the client pickleball. I will be up here. If you've got any questions, please let me know. But thank you so much for your time and attention. And for those of you that are watching on the video, if you have any questions, please go ahead and send it to the office. We'd love to have a conversation with you. Thank you. Thank you very much. Thank you.